Hello everyone, I'm Mark Sabrin, investment advisor and certified financial planner with Harbourfront Wealth Management in Winnipeg. One of the common concerns we come across with new retirees is what to do with their investment portfolio. It can be an extremely intimidating position to be in, as the choices they make today could affect their family's future for years to come. And I don't blame these new retirees one bit. One minute they're working, and then the next they have $1 million from their pension, or if they're a business owner, the sale of their business. That's a lot of money to all of a sudden fall into, and as soon as they turn on their nightly news, it seems like the world is ending. Let's meet Bill. Bill is 65 years old and has just retired from a long career working at Manitoba Hydro. He commuted his pension and would like to receive $50,000 per year from his $1 million retirement portfolio. Bill has some investing experience, but his biggest concern is if the stock market goes through a significant correction like it did in 2008. He does not want to go back to work. Bill also watched my previous video and saw the long-term effects pulling money out in a loss position had on Jim's portfolio. He would like to avoid the same fate. Let's review how we'd structure Bill's portfolio so that he could receive a consistent paycheck during his retirement without having to worry about pulling money from the stock market in a loss position. We use what's called the bucketing strategy. Each bucket serves a purpose and has a role to play during Bill's retirement. The first bucket will be used to pay Bill his required yearly income. As previously mentioned, Bill would like $50,000 per year from his portfolio, so we would deposit the same amount in the first bucket. Our goal is to provide liquidity and to preserve the money in this bucket. So in this case, we would invest the funds in a regular savings account or leave as cash. Since the first year of Bill's retirement is covered, we can now move on to the second bucket. This bucket will provide for Bill's income in years 2 to 9 of his retirement. At $50,000 per year, we would need to deposit $400,000 into Bill's second bucket. Our goal is to provide Bill with safety and future liquidity. We want to invest in something that will have very little fluctuations, but at the same time, pay us some income so that the value of Bill's portfolio can grow. Bonds and GICs work great in this situation as they will provide regular interest with minimal fluctuations. Once Bill's second year of retirement begins, we would transfer $50,000 from Bill's second bucket to the first bucket so that it is filled up again. Our goal with this strategy is to always have money available to spend in the first bucket, as the investments within it are immediately liquid and will not fluctuate in value. We would deposit the remaining funds in the third bucket, which would be invested long term. This is often referred to as the investment portion of the portfolio. This is the money that we will require in 10 plus years to provide Bill with an income. Because we have such a long time frame, we can be more aggressive with this bucket and invest in the stock market. The stock market has historically been a great place to invest for growth, but it also comes with good and bad years. Let's say during Bill's first year of retirement, the stock market has a great year. In this case, we would transfer $50,000 from Bill's third bucket into his second bucket. If you recall, we already transferred $50,000 from the second to the first bucket, so this would refill the second bucket as well. If the stock market had a bad year, we would not transfer the $50,000 from the third to the second bucket. When it comes to investing, you don't want to make a habit of withdrawing money in a loss position. We would wait until the stock market recovered, and we would then make the transfer at that point. This is a great strategy for Bill as it provides him with a disciplined investment approach that is easy to implement. His portfolio is properly diversified and will provide him with a regular paycheck in retirement. Bill's biggest concern with his portfolio was going through a stock market crash like in 2008. The 2008 crash was the worst on record since the Great Depression. As a point of reference, it took the Canadian and US stock markets approximately 6 years to recover to their original levels. With this strategy, Bill would have never been forced to withdraw from the stock portion of his portfolio, as he has a 10-year buffer built in. This strategy gives Bill the flexibility to sell his stocks when he wants to rather than when he has to. Compared to my last video, Bill can comfort himself knowing that he has a withdrawal strategy that will not be affected by the day-to-day movements of the stock market. He can sleep easy at night knowing his financial future is well taken care of. If you enjoyed this video, please drop a comment or like below And for more videos or tax saving tips, visit our blog at winnipegfinancialplanning.com.